Hi there and welcome to Property Tribes TV, where we're about to present an exclusive interview with Dan Neidle of Tax Policy Associates. Now, Dan is something of a controversial character in the landlord tax scene because he's behind two investigations into high-profile landlord tax planning schemes which have attracted the attention and action by HMRC. Now, before we start the interview, we just wanted to point out that this interview is not just for the minority, the people actually affected by these schemes, although Dan does share some very helpful insights for those people. It's really for the wider landlord community. We want learnings to come out of all of this so that landlords can make wiser tax planning choices in the future and know the questions to ask and who they should ask. So without further ado, we present Dan Neidle in this interview on Zoom. Well, welcome, Dan. Thank you very much for joining me on this call. And we're going to dive straight into the questions. We've got around 20 odd. So first of all, just to give context to the conversation, could you give us a quick overview of your professional career and your credentials?
I was a solicitor for 25 years. I qualified in 2000. I became a partner in 2008. I became a head of tax at one of the largest law firms in the world. I then retired, to my clients and colleagues' slight surprise, and founded a think tank, Tax Policy Associates, which I work with an array of people, tax and legal specialists from mostly across the UK, and I write about and investigate tax and tax avoidance.
I think that is an interesting point, Dan, that it's not just you at TPA. You're working with a community of tax experts, and you really want to scrutinize tax, don't you? Did you have any element of wanting to right any perceived wrongs about taxation?
So why did I found Tax Policy Associates? I think it's a mixture of reasons. One reason is I love being a lawyer, and when I retired, I wanted to keep on being a lawyer. But I also wanted to improve the tax coverage in the media, which often is focused on things that I think many tax advisors regard as superficial. Stories about tax avoidance that just aren't right, endless debates about the tax rate going up by a penny or down by a penny, which is kind of not that significant in global terms, and never really any focus on the realities of how tax avoidance works, on some of the deep structural problems with the tax system. And so I wanted to focus on that. And with a bunch of people very generously providing their time for free, we've been able to do that across an array of different taxes, certainly far beyond my own expertise, which was, I was fundamentally a corporate tax guy, but we are able to cover many more areas than that. And progress is slow and progress is difficult, but I think it's fair to say we've influenced the policy debate in a way which is helpful in at least a couple of different areas.
Well, most definitely. You've scrutinized politicians, you've scrutinized celebrities.
Now, the whole investigation thing happened by accident. The original idea was it would be nerdy tax policy pieces read by just a couple of hundred people. And then someone suggested I looked into some perhaps tax avoidance by Jeremy Hunt, which we did, and there was nothing going on there. And then someone suggested we looked at tax avoidance by Rishi Sunak, and there was a Channel 4 piece suggesting that he'd avoided tax when he was working in New York, and we looked at it. It was absolute nonsense, so I said so. And then someone suggested we looked at Nadeem Zahawi, and suddenly it was much more interesting. And I discovered that there were skills which, for a tax lawyer, are kind of ordinary. It's very normal as a tax lawyer. Your client asks you to look at this particular company they're thinking of financing or taking over or doing some kind of deal with, and you look at it and you check what's going on is appropriate. And for me, that was the day job. But for investigative journalists, normally of course they'd have the skills to do that. They haven't worked as a lawyer for 25 years, but I could look at Nadeem Zahawi's companies and I could see things which were pretty obviously wrong. And it was that which both broke what became quite an interesting story, but also showed that I and we more broadly should be looking at investigations as well as doing pure policy stuff.
Indeed. So just going to basics really, what is the difference between tax avoidance and tax evasion?
So in theory, the difference is really clear. Tax evasion, you go to jail. There's been dishonesty. So I claim that I spent £1,000 on bricks or uniforms or something else. I claim a tax deduction for it, but I never did. I made it up. I lied. I knew I was lying. It was dishonest. That's tax evasion. I'm potentially going to be prosecuted and might even go to prison. Tax avoidance is much harder to define. So there are various tax rules which look at things that might be called tax avoidance or might be called tax avoidance schemes. There's no single definition of tax avoidance. There kind of can't be because it's so subjective. Give an example. So if you go and buy chocolate from the candy counter, the sweet counter, and you're in your local supermarket, there's been 20% VAT on that. If you go a bit deeper into the supermarket to the baking section, there's no VAT on the chocolate because it's an ingredient. It could be exactly the same chocolate, exactly the same ingredients, but in a different wrapper, one saying cooking chocolate, one saying chocolate, and yet different tax. Is it tax avoidance if I go and buy cooking chocolate with the full intention to eat it as a snack? And no, of course not. That's ridiculous. It's equally ridiculous to say it's tax avoidance if I put money in an ISA, because yes, in a literal sense, I am avoiding tax, but Parliament intends that I do that. It's a choice that's been created for me by the rules. If, on the other hand, I do something very complicated with a whole bunch of money going in the circle and I claim, aha, I now have a tax benefit, and it's not a scheme set up by Parliament, it's something that I devised myself using particular interpretations of the rules, well, that may well be tax avoidance.
Indeed,
Now,
I've
someone
heard
might say it's not, it's tax planning. What's the difference between tax planning and tax avoidance? And you can get onto quite difficult territory. But sometimes, and maybe we'll come on to some examples, sometimes it's very clear. I think generally if you're doing something commercially and you somewhat tweak it to fall within rules that Parliament's intended people can use, then that is probably planning. But if you're doing something to get an advantage that Parliament didn't intend, and particularly if it's something that's being mass marketed, then it's much more likely to be considered tax avoidance. But this is a philosophical question, which isn't actually very important. The real question is, what are the tax rules going to do to the thing that you're doing? Whether or not we choose to call it tax avoidance. And I try not to use tax avoidance as a scare word. I try not to write newspaper headlines saying outrageous tax avoidance. I want to look at what's actually happening and what the legal analysis of it is.
Indeed, and this reference to what Parliament intended comes up a lot. And thank you for your explanation, because I think a lot of the confusion around landlord tax planning is because of some of these, grey areas that you've mentioned there.
Mhm.
So, how did you first become interested in landlord tax planning schemes?
In the 2000s, people started selling schemes to enable individuals to avoid tax on their employment income. Those schemes involved the employer, instead of paying you a salary, they'd make a payment to an offshore trust, and the trust would then loan it to the employee. And the idea was that, unlike normal employment income, the loan wouldn't be taxable. And HMRC knew this was happening and challenged it in a few places, but didn't really see how big it was becoming. And we got to 2014, 2015, and there were somewhere between 50,000 and 100,000 people who bought into schemes like that. At which point HMRC suddenly woke up, went, oh my God, what's going on? And created a rather draconian one-off retrospective tax charge on everyone in that position called the loan charge. And it resulted in many people going bankrupt. Some tragically have killed themselves. The responsibility for this ultimately doesn't rest with HMRC, it rests with the people who sold those schemes. But HMRC, in not realizing what was going on and not reacting quicker, share some responsibility. Now, why is that relevant? It's because I'm quite interested in looking at other areas where there is significant tax avoidance happening and maybe tax evasion happening, but HMRC isn't spotting it, and where it's getting to the point where it's not just a few things here and there, but it's becoming quite mass market. So another example we read about very recently was R&D tax relief, where perhaps as much as £10 billion of tax has been wasted in fraud and wrongful R&D tax relief claims. And we were able to investigate one particular advisor and say that we thought what they were doing was fraud. And that's, I can't talk much more about that now because many of the people involved has now been arrested.
Mm.
So I'm very interested in areas like that. And landlord tax was kind of similar. We were getting lots and lots of tips from businessmen, from landlords, from tax advisors who were seeing some people selling schemes to landlords, which they thought technically just couldn't work. So it's not that they disagreed with them or they thought it's a bit difficult on balance, it doesn't work. They thought these schemes don't work and people aren't being warned about the risk. And eventually this is going to end really badly for everyone involved. And HMRC needs to get a grip of it now. And that's what interested us about the area, that there was quite bad stuff happening and HMRC didn't seem to have noticed.
Okay, so we're going to move on now and talk specifically a bit more about, there's two key schemes which have been caught by HMRC. One is what I will call the hybrid scheme, and the other is what I will call the SIS scheme. And one of the scheme purveyors, we understand, invited you to a Zoom call and also to meet in person to try and explain to you how the scheme worked, and so on, and you declined to do that. Why didn't you want to meet up with the scheme organizer?
We get this all the time. We see someone doing something, we write to them saying, yeah, we've got some questions about this, we think it may be improper, can you please let us know, can you respond? Why do we do that? We do it because I don't want to get stuff wrong, because it would be terrible if I damage someone's business by saying things that were incorrect. Even if I've got it right, if I haven't given them the chance to respond, we are potentially, and I personally, could be subject to a libel claim. So it's absolutely standard in the media that you give someone you're thinking of writing about the right to respond. Now, quite often, people who are not that sophisticated, or well, let's say they're not that sophisticated, they think the answer is to have a cozy chat over a pint and it'll resolve itself, that they're so clearly right that by sitting down over a pint, I will see that they're right. And that's not how it works. If you're going to respond to me, respond in writing. I don't want this to become some kind of circus. I'm not interested in the personalities. All I want to understand is the technical analysis. And that's something you do in writing. And that's what I would have done when I was a lawyer. And that's what I'm doing now. And when people suggest that they want a sort of debate over Zoom, which they want to broadcast to their followers, that shows they've got no interest in the technical analysis and they just want a circus. No, not going to play that game.
I completely understand your position there, Dan. Do you believe that if all criteria are met and all documents properly drafted, that a portfolio can be transferred to a company in a tax efficient manner?
So I think we go back to what's intended by Parliament. So Parliament could have passed a law that said landlords are now denied all relief for interest. They didn't do that. They passed a law saying individual landlords no longer get tax relief for interest. Instead, they get a credit of 20%. And when Parliament did that, it was very clear that they could have stopped incorporation and didn't. So it's absolutely a valid choice by a taxpayer to incorporate their business, but it's a dangerous one. Why is it a dangerous one? I think whenever you're engaged in any kind of commercial transaction, and certainly in tax planning, you've got to think about the risk and the reward. What's the benefit of what I'm doing? And what's the worst that would happen if it all goes wrong? So when you're incorporating a landlord business, what's the benefit? Well, the benefit is you will get the ability to deduct interest. You get a lower rate of tax on rent, albeit that when you then pay it to yourself, you may end up with a not quite so low rate of overall tax, but there's a benefit, no doubt about it. What's the cost? Well, the worst case is that you have a large capital gains tax hit and a large stamp duty hit on moving the properties into a company. And that hit is often going to be many, many times the tax benefit. So I think you need to be extremely sure as a landlord that the CGT and the SDLT works. And this is where you can tell the difference between a real advisor and an advisor who isn't serious. A real advisor will tell you about this risk. They'll say, if this doesn't work, here's what the cost is going to be. However, I think that you have and then they'll say something like, it's almost certain, it's probably okay, but there's a risk, or it's 50-50. They'll give some indication of the level of risk. Any advisor who doesn't do that, who doesn't explain the downside and doesn't talk about levels of risk, don't walk away from them, run away from them. If an accountant or solicitor advises without talking about risk in any kind of transaction involving tax, they are possibly negligent, but certainly not behaving like a proper advisor should do. We look at people like Less Tax for Landlords and Property 118, they never talked about risk, which is it was deeply irresponsible. So it's a long way of answering your question. Can you incorporate legitimately? Absolutely, you can. Of course, you can. Can it be done without CGT? Sure. I mean, if you've got an active enough business to satisfy the test, there's no reason why not. But be cautious on this because the downside is very great indeed. Incidentally, I think the law there is rubbish. The law should be changed. It's daft. There's so much uncertainty on such a common transaction, but I should write about that sometime. On the stamp duty, it's more difficult, and very possibly there will be stamp duty. But again, it's a question of fact and degree. So yes, it absolutely can be done legitimately. Incorporating is not tax avoidance, but incorporating is dangerous. You need to be careful.
Thank you so much for that explanation. You touched on this briefly earlier, but I just want to go back to it because I think it's such a key thing in this whole situation that has arisen with landlord tax planning. Why did HMRC wait so long to identify these schemes? Because I think we're talking 7 or 8 years now. And would HMRC have caught up with these schemes eventually, even if you hadn't investigated them?
I'm certain they would have caught up with them eventually. We know quite a few people who've told HMRC about the schemes. We know that there were people within HMRC who were aware of the schemes. Why they weren't acting, I'm not sure. I think there is a general point to be made about HMRC not being as effective as it used to be in terms of having feet on the ground and seeing what's going on. I don't think that's the explanation here because I think HMRC had enough time and these people were very visible. There are some tax avoidance promoters where they have nothing on the web and you can only see what's going on by speaking to them, speaking to someone who they've sold the product to. But Less Tax for Landlord and Property 118 were everywhere. They had a massive web presence explaining exactly what they did. They weren't really hiding it. They were at landlord conferences and exhibitions. They were speaking about it. It was all there. And I was getting lots of messages from lawyers, accountants saying, what's going on here? Doesn't this default the mortgage? And it took me a while to get around to it, to look at it. But as soon as I did, it was really clear that something very strange was happening.
Well, we're going to move on to that shortly. Various reassurances were given by the scheme providers, and they're still doing it actually. The HMRC have reviewed individual client returns over years, and it's led to no kind of penalties or extra tax at all. What do you say to such reassurances that are being given by these schemes?
First thing is, like, what exactly did HMRC look at? Was it what sometimes called an aspect inquiry, where they look at one small thing? Or did they look at the entire structure? And was the true nature of the structure disclosed to HMRC? I've got no evidence that it was. Quite early in the day, Property 118, in fact, in one of their early communications, sent to me what they said was an inquiry from HMRC, and it was some minuscule point of no real relevance to the structure. So I'm very doubtful there was ever full disclosure of the structure to HMRC. And if you make a settlement with HMRC and settle an inquiry without making full disclosure, HMRC can then come back to you and reopen it. And if you are not the person who was involved in that inquiry, it doesn't matter at all what happened in the inquiry. Even if complete disclosure was given, even if HMRC looked at absolutely everything and said, yeah, this is fine, you as someone else can't rely on that. And so when these advisors turn round and tell their remaining clients, yeah, you don't need to worry, this has been looked at before, they, I'm afraid, are misleading people, because that in reality gives you no comfort. You cannot, in a tax tribunal, run as a defence, oh, this was cleared by HMRC for some other person. It doesn't work.
I don't even think HMRC clear schemes either, do they? They
No,
don't give like the rubber
they don't.
stamps.
And you could have an inquiry. Imagine a theoretical inquiry where HMRC said, and this less tax for landlords thing you did, we don't think it works. And then less tax for landlords provided huge detail of the structure, explained everything. HMRC said, yeah, yeah, actually on reflection, we think it works. Imagine that happened. I doubt it did. But imagine it did. That gives no comfort to a different less tax for landlords client today. None at all.
Okay.
The law on this is clear in a case called Wilkinson, another case involving the delightful Mr. Al Fayed, that if the law says one thing, then no practice of HMRC can give a different result. And there's there's another line of case law on when you can rely on a clearance from HMRC, and you can only rely on a clearance from HMRC if that clearance was addressed to you. And if full disclosure was made, the term normally used is you have to have your cards face up on the table. The case there, it's MFK, sometimes referred to as Matrix, but involved a company called Matrix Securities. So yeah, it's very important that you cannot rely on an HMRC clearance given to someone else.
Thank you for clarifying that. Now, both schemes said that KC's counsel was sought, and they're actually still saying it. How reliable is a KC counsel's opinion or even endorsement of a tax structure? Can the clients rely on that opinion?
So neither scheme had any involvement from KC's when it was drawn up. So the Property 118 scheme, Property 118 themselves had no one qualified working for them, no qualified tax advisors, no qualified solicitors. They relied heavily on a rather odd barristers' chambers called Cotswolds Barristers, whose registered office is an aircraft hangar. And Cotswolds Barristers, they're not tax barristers. None of them had any tax experience prior to devising this structure. So that Property 118 scheme was not devised by KCs. As for less tax for landlord, they're a slightly strange case because the chap who created the structure for them is a qualified accountant, or was. He was expelled by the ICAEW, but they never ran it past a barrister. So at the time, these schemes were not devised by technical specialists, neither of them. Now, since both of them have gone to KCs, here's the thing. I could devise instructions and send it to a KC and pay the KC for an opinion. And if I go to the right KC and I write my instructions properly, I can probably get the KC to say that my structure works. That does not give much comfort to someone else who is relying on it. That's someone else, what they would want, what the actual landlord entrant to the structure wants. They'd want someone to write to the KC with completely neutral instructions. So, here's the structure. What do you think? There's these reasons to think it might not work, these reasons to think it might. What do you think? And if you do that, and if you go to the right KC, you'll get a very, very reliable result. But don't go to a KC who you're paying to tell you the structure works, get the KC to say the structure works, and then say to your remaining clients, hey, look, this person I paid agrees with me. It's meaningless. A better way to judge it is to look at other tax advisors and say, well, what are other tax advisors saying? You can see what I'm saying. I have no particular, I have no dog in this fight. I have no conflict of interest. Look at the people who work with me, some of whom literally wrote the book on capital gains tax and stamp duty. They think these structures are hopeless technically. And you can look online, you can look at other advisors commenting, and you'll see it's pretty remarkable how little support, almost no support, perhaps even no support at all in the profession there is for the structure sold by either of these groups. That's pretty remarkable.
It is. Now, your investigations actually created a wealth of education for landlords around tax planning. And we had things like a spotlight, DOTAS notices, stop notices. I personally had not really heard of any of these things before. So I think that's one very positive aspect of the work that you've done, Dan, is it's really opened up the conversation around landlord tax planning and helped to educate people. But those three words I just mentioned, they're forms of notification
Mm.
from HMRC. If you could just address each one and say, on a scale of 1 to 10, how serious is it for
Okay,
Spotlight, DOTAS, and Stop Notice?
so the spotlight is nothing technical. The spotlight is simply HMRC saying, be warned, taxpayers, we've seen this thing and it doesn't work. You tend to see that for mass marketed schemes. You don't see it for things where HMRC merely technically disagrees. It has to be something quite extreme.
So would that
So,
be, sorry, Dan, to jump in, would that be to
mm,
encourage people to address the issue within their tax returns?
yes, I think it's to sort of persuade people to leave the structure if they're in it already, and it's to warn new people not to go into the structure. It's a cheap thing for HMRC to do legally because there's no process they need to follow. So it's very easy. But they don't do it very often. There have been 63 in, gosh, 20 years. So it's a pretty rare thing. So we, on the day that we published our briefing, our report on less tax for landlords, the less tax for landlords structure got put in a spotlight. And I think that shows quite how bizarre and odd the less tax for landlords structure is. I don't think landlords would normally need to worry about spotlights at all. Spotlights normally for exotic artificial tax avoidance schemes. So that was a very odd turn of events. And that's because the less tax for landlords scheme is extremely odd. DOTAS, it's the disclosure of tax avoidance scheme rules. The idea is that back when tax avoidance schemes were much more common, HMRC was always playing catch up. A taxpayer would do a scheme. HMRC wouldn't know about it. The taxpayer would file the tax return. HMRC would then look at it and go, bloody hell, what's going on here? They'd sit down with the taxpayer, they'd try and work it out. Then eventually they'd realize, hang on. This is something where maybe we need to change the law. But by that time, it was kind of too late. The taxpayer had already got at least one tax year out of this. So the idea of DOTAS was that HMRC would get advance warnings of tax avoidance schemes. They could then choose to challenge them or choose to change the law. We need to be a bit careful because some of the commentary around, in particular, the Property 118 DOTAS notice suggests that whether you're a tax avoidance scheme comes down to the kind of philosophical question that I was batting around earlier. Did Parliament really intend this? That's irrelevant. DOTAS is at its core really simple. The key question is, are you doing something where the main benefit or one of the main benefits is tax? Most things we do in life are not just done with a tax main benefit. If it has a tax main benefit, then at that point you have to see whether certain of what's called hallmarks are there. And the hallmarks, which are particularly relevant here, there's a hallmark for mass marketed schemes, where you have a scheme which is essentially standardized and sold to lots of people. And both the less tax for landlord scheme and the Property 118 scheme, I think, are clearly mass marketed schemes.
Mm-hmm.
There's another hallmark for premium fees, where people are paid a fee which represents more than the hourly rate. And goodness me, the amounts being charged by Property 118 and less tax for landlords are far higher than most accountants would charge for an hourly rate. So probably the premium fee hallmark applies. So if that's the conclusion, if you think that the main benefit of these structures was to pay less tax, then that's kind of it. DOTAS applies. And one of the first questions I ever asked in correspondence, Property 118 and less tax for landlords, was, why doesn't DOTAS apply here? And they were never able to answer that. And even now, all the bluster, they're not able to provide a technical answer to that because I think there isn't one. So both structures should have been disclosed under DOTAS and weren't. Property 118 are appealing. I don't know if they'll actually go ahead with the appeals because the technical position seems pretty hopeless to me, but let's see. What does it mean for clients? If your structure is disclosed to HMRC under DOTAS, you can be pretty sure HMRC won't like it. It doesn't mean it technically doesn't work. Remember, the whole point of this was HMRC get to look at the scheme and decide, do they challenge the current law? Do they need to change the law? So HMRC could get notified under DOTAS, say, yeah, we don't like this, but we think it works today and we'd have to change the law to stop it. Be a good result for a client. But realistically, if you look at cases involving tax avoidance schemes that have hit the courts in the last 20, 25 years, the taxpayers lost in almost all of them. So DOTAS it's a sign that things are going to end badly. And for this reason, almost everyone selling tax avoidance schemes these days tries desperately hard not to disclose under DOTAS. Normally they have to, technically, but they will dream up any old reason not to disclose. As a taxpayer, you do not want to be doing a DOTAS scheme. I think I'm right in saying every tax advisor, every reputable tax advisor will agree that you should not be doing something which is disclosed under DOTAS. That is by definition high risk. And if you're Barclays Bank, maybe you're happy doing high risk tax transactions, but most normal people are not. You should steer clear.
Well, obviously the DOTAS only came out after your investigation when a lot of people had been caught by these schemes.
Well, the problem is Property 118 and less tax landlords should have registered under DOTAS themselves. They should have notified HMRC of their structures back when they developed them. They didn't. And so HMRC had to do it after the event. You're quite right, and that puts people in a bad position because they are now locked into a structure that's high risk, which they didn't know was high risk at the time.
Exactly, exactly. And just finally, stop notice. That's obviously to do with marketing the scheme and making sure that it's discontinued and not presented to anybody else.
Yeah, the stop notice is really serious and really unusual. The idea of a stop notice is that there are some promoters who will keep trying to flog schemes which don't work. And the stop notice, first of all, there are penalties if you continue to promote a scheme that was subject to a stop notice. And then from February this year, it's a criminal offence to promote a scheme that's subject to a stop notice. So stop notices are very unusual. And I was surprised to see one issued to Property 118. I don't know why one was issued. My guess is that Property 118 was still trying to sell the scheme after HMRC had said it didn't work. And so HMRC had a sense of humour failure. But I don't know. There could be some other reason.
Okay. Now, there's been some narrative from the scheme providers that you are extreme left wing, that you despise landlords, and you have some sort of personal agenda against landlords. And I just wanted to give you the chance to respond to that because it's very ad hominem. And in my own experience, if you provide a service to the public that certain quarters don't like, one very typical response is to become very ad hominem about the person and try and discredit the person and thereby whatever they're saying. So what do you say to that narrative that was put out?
Yeah, I mean, anyone who looks on the Property 118 website will see the most extraordinary things being said about me. So do I hate landlords? I've been a landlord. I'm not a landlord myself now, but I've been a landlord. So no, obviously I do not hate landlords. I think it's important we have a private rented sector. I think that's a good thing. And yeah, stepping back for a second, I think we've probably published about 300 pieces on the Tax Policy Associates website. Of those, maybe 10, max 15 relate to landlords. So my life's work does not involve landlords. Do I think that incorporating is evil tax avoidance? No, of course not. I've even written an article about incorporation and what landlords should watch for when they incorporate. So the question for me is someone selling a scheme to landlords which doesn't work? And the answer is yes. What would have been the consequence of that if I'd done nothing? And the answer is not that it would have ended happily ever after. The answer is that HMRC would have caught up with it. Landlords would have had years and years of back tax to pay, plus interest, plus penalties. My involvement likely meant that HMRC stopped these schemes earlier. That is a good result for landlords. Not a bad result. It may not feel like that to some of them in the immediate, but it's nevertheless the truth. It's a good result.
Well, I understand that, Dan, and if it had carried on for many more years, as you say, they would have ended up paying more penalties and fines and whatnot when it was discovered. So in a way, you have done them a favour. They won't see it like that, unfortunately, and this video isn't for those people that are affected by these schemes because
some of them do. So I've had a lot of
Okay.
discussions and calls with clients of Property 118 and less tax for landlords who do see it in a sensible way, but obviously it suits the promoter to take another approach.
Mm. Okay. Well, this interview really, what Nick and I wanted it for was for learning, to have lessons that have come out of all of this to assist landlords in the future, because the people that are
Mm,
affected, they're on their own journey to however they're going to resolve it. That's a separate issue. This is more about, well, what can we learn from this? What can we learn about landlord tax planning going
mm.
forwards? I felt for you when you were getting these ad hominem comments. One that really stuck out for me, and if you don't want to answer it,
Hmm.
don't, we'll cut it out. But one landlord actually said that you'd ruined her business, and she invited you to attend uh, when she met with all her tenants to serve them notice. What's your
Oh, and she
response
then
to that?
published the address of her tenants on the internet.
No,
Yes.
she didn't. She just said,
No, she did. She did on Twitter. She published the address of her tenants. She may have deleted it subsequently, but she
oh,
absolutely
really?
did,
Oh, wow.
which was pretty extraordinary. So, question is, what the structure that she entered into, does it work or not? And the answer is it doesn't work. Would HMRC have picked that up eventually? Yeah, they normally do. It would have been picked up eventually. So her problem ultimately is not with me. Her problem should be with the people who sold her a duff structure. If she can't see that, then I'm really sorry. But what she should do, and what when I asked her, she refused to do, is you don't need to believe anything I say. No one needs to take anything on trust that I say at all. Go and speak to a tax advisor. By a tax advisor, I don't mean a shiny suited salesman. I don't mean someone who's linked in with this and getting a commission from this. I mean someone who's independent, someone who's worked as a tax lawyer for many years, an accountant who's CIOT or ATT qualified. Speak to them. Ask them what they think. And that's the way to judge whether these schemes work, if you don't want to believe me. If you do that, I'm pretty sure that you'll hear something very similar to what I've been saying.
Well, that kind of leads on to my next question, because where can people get trusted advice from with regards to landlord tax planning? And should
Hmm.
tax planner be a protected word in future, like solicitor?
The warning signs for these firms are warning signs that were very clear to professionals, but I think not clear to the wider public and not clear to landlords. The warning signs are first that the people running these firms and often the people giving the advice and certainly the people speaking at conferences were not lawyers or accountants. They're salesmen. I mean, maybe you buy double glazing from salesmen. That's probably not a good idea, but definitely don't buy tax advice from salesmen. You should be speaking to some nerdy tax advisor who really knows their stuff. The second sort of alarming sign is that they were selling magic sauce, special sauce. They were selling something which they said was better than anything else out there and which was different from almost anything else out there. And that should send alarm bells ringing. Again, if you are Apple, you're probably happy doing some tax structure, which is very complicated and no one else in the world does. But if you are a normal person, and not a billionaire, you should be in the crowd. You should be doing the same kind of thing as other people. And doing something which is innovative, different, new should really be sending off warning signs. And these firms were offering something that was very different to what the traditional advice would have been. The traditional advice is incorporate, try and get within the exemptions, only go ahead if you're really confident that you have the exemption. So they offered something else, and that something else was, I think, alluring. It certainly seemed better than the standard way of doing it, but the fact that it was so much better and so different was itself a warning sign. So go to a boring regulated tax firm. Incorporation is not very difficult technically. It's the issues are very well understood. There's loads of firms who can do it.
Now, one tax expert said to me that the SIS scheme, the Property 118 scheme, had the crux of a good bit of tax planning, but it went too far. Do you agree?
The SIS scheme, probably everyone watching this knows, but in case there's anyone who doesn't, the idea is instead of selling the property across to a newly incorporated company, you declare a trust, or you sign a sale document, but you don't perfect it, which is the term lawyers use to mean that the legal title moves. So as far as the land registry knows, the landlord remains the owner of the property, but the company is the beneficial owner of the property. Now, this was something which a number of lawyers wrote to me about because they thought that this defaulted the mortgage. And I used to work quite extensively in real estate finance, so I'm very familiar with how mortgages work as a legal matter. I spoke to a bunch of finance lawyers who are much more familiar than me with how mortgages and security works, and I spoke to UK Finance, the representative body for mortgage lenders, and all of them thought this defaulted the mortgage because you were selling the properties out from under the person who'd signed the mortgage, which is extraordinary. So the biggest problem with the structure by far is that it defaults the mortgage. There are then a bunch of complicated secondary consequences that follow. And one of them is DOTAS. The reason DOTAS applies is kind of interesting. So I said before, DOTAS is relevant if a main benefit of what you're doing is the avoidance of tax or getting a tax benefit. Why doesn't DOTAS apply to a normal incorporation? Easy, because a normal incorporation does a whole bunch of things. It means that the individual landlord no longer has personal liability, which is very important. It means that both liability to the tenants and liability to the bank. It means that contracts move. It means that you have access to commercial finance. It means you have access to commercial agreements with agents and other third parties. There are many things that are different about being a landlord through a company and being a landlord personally. So you can't look at it and say, aha, this is only being done for tax. But look at the SIS where you declare a trust. Nothing changes at all except tax. And that means that suddenly there is a tax main benefit, DOTAS applies, and a whole bunch of other anti-avoidance rules apply. We can then get into the detail, which is probably what the chap you spoke to was talking about, that the implementation of the structure was bad with a very serious drafting error in the documents and a failure to properly create an indemnity, which means that even if the structure could have worked in principle, it then failed in practice. So I think it goes back to the people involved just not being experienced, either Property 118, none of them qualified at all, or Cotswolds barristers, not tax lawyers. So there were missing points the tax advisor would have picked up.
Where do you draw the line at incompetent and greedy compared to fraudulent and possibly even criminal?
So I think Property 118, it's pretty clear they were just blundering and didn't know what they were doing. I don't think it was, in fact, I'm pretty certain it wasn't deliberate. Less tax for landlords is harder because you had a qualified accountant drawing up a structure and making claims about it that no one understands. So, for example, less tax for landlords, their big claim, why they were better than Property 118, was that their structure escaped inheritance tax. Fantastic. But just completely wrong. There's no way in which moving to an LLP does that. No one can explain why he thought that happened. So there's an open question as to several aspects of the less tax for landlord structure as to why they ever thought it worked. Either they were incompetent to a degree that's hard to understand, or it was deliberate fraud. I don't know.
Okay.
But they've never explained it. They've never explained why they thought the structure worked. They haven't explained, certainly haven't explained to me. More importantly, they haven't explained to their own clients why they thought the structure worked. And that is deeply suspicious.
This next question is from another tax advisor. Do you feel HMRC will pursue the directors of these companies personally for the DOTAS fine if these companies go into liquidation?
I think they should. I think there's a problem with people selling tax avoidance schemes. The schemes don't work, and then it's the taxpayers who end up picking up the bill, and the promoters just walk away scot-free. So yes, I think it's quite important to, I mean, not only as a measure of justice, but also to incentivize good behavior by other people in future if there are clear consequences from this for those involved.
How much is a DOTAS fine out of interest, do you know?
It depends. It can be up to £1 million. There's only one case of £1 million fine being issued. The company that the fine was issued to were advised by the same KC, who's now advising less tax for landlords, that they didn't need to disclose under DOTAS. The tribunal thought their argument was hopeless. They had to pay it. The company then promptly went bust and didn't pay it. And as far as I know, it's not being levied on the directors. So there is unfortunately a problem with directors getting away with leaving their clients in a horrible mess. I mean, I could talk about this for ages, but I feel sadly that HMRC just follow the money. They go for the path of least resistance, which is going after the taxpayers. It would for them be a waste of resources. It would be expensive, difficult. It'd probably be litigated to chase the directors. And in the short term, that's right. In the long term, for, let's be pompous about it, for the rule of law, for justice, it's important that there are consequences for people who sell hopeless tax avoidance schemes.
Now, as you alluded to earlier, it wasn't just less tax for landlords and Property 118, the companies, they had what I will call enablers around them that helped facilitate the structures, also the marketing and so on. A lot of that, in fact, almost all of it, as far as I'm aware, and I'm quite across the social web for landlords, there was a very severe lack of transparency about who was an introducer, how much they were getting paid. This wasn't signposted. There was a lot going on behind closed doors. How do you think those enablers will be, or well, can they be held to account? One of them has been named on the recent publication of Property 118 on the HMRC list of tax avoidance schemes. So it seems that they have picked up on that. But I think all of these people that facilitated and enabled these schemes,
Mm.
they are partly responsible as well.
Yeah, I think there's a problem with some accounting firms who recommend structures to their clients and don't disclose that they're getting a kickback for doing that. Now, if you are a member of a regulated body, the ICAEW or the CIOT, certainly if you're a lawyer, you have to disclose if you're getting a commission. In fact, I think lawyers are probably forbidden. I may be wrong on this. I think lawyers may be forbidden from receiving them at all, but accountants are permitted to receive them as long as they disclose it. And I think often they do not disclose. So I would say to anyone watching this who has recommended any of these structures by their accountant, have a look and see if your accountant told you he was receiving a commission. If he or she didn't tell you, you should be very concerned and you should ask them now.
And what could you do about it if they admit that they had received a commission?
Well,
That give you a route of redress?
you should certainly report them to their professional body. Whether there's potential for a legal claim, I'm not sure, but possibly.
Okay.
But these legal
This is
claims are normally difficult because negligence claims, which is what they'd probably be, are long and expensive. And whilst a landlord may have lost quite a lot of money on this, it probably is not enough money to justify funding an expensive claims. You would need several people coming together to do it. I know there are lawyers who are trying to put together joint claims against both less tax for landlords and Property 118, but it's hard.
Well, it is, and they say that they've got their solutions to this scenario. And how how do you know that they've got a trusted solution? I mean, it's a minefield for landlords, to be honest.
Yeah, I mean, you could end up paying a large amount in fees and getting nowhere. But the priority, as I see it, for any landlord caught up in these schemes is to be getting independent tax advice. The question of whether you can sue separately and recover separately, yeah, it does need to be thought about and progressed. But the absolute priority is sorting out the tax. You need to go to someone who is independent.
This is an interesting one, Dan. Is property investment unique in that it can be categorized as either a passive investment business or a trading business? Was your investigative effort motivated by this anomaly at all?
Short answer, no and no. Long answer. There's a fundamental concept in tax of trading versus investment. Generally speaking, if you're an individual and you are carrying on a trade, you get to deduct your finance cost, your interest on any loans you take on for that trade. If you are not carrying on a trade, you don't. So, for example, if I set up a business as a lawyer, if I'm in business by myself as a lawyer and I take out a loan and overdraft to support that, I get to deduct the interest on that because I'm carrying on a trade or profession as a lawyer. Let's say I invest in shares, which I do, and I borrow to acquire shares. I do not get to deduct the interest cost because I'm not trading. It's an investment. It's passive, if you like. Now, land is different. because when you have a investment in land, you are deemed to be trading for tax purposes. So that's why historically, if you hold land completely passively, you're not buying and selling houses. You may not feel it's passive, but it's not a trade in tax terms. You still got a deduction for interest because it was deemed to be a trade. Now, of course, what's happened is it's still deemed to be a trade, but your interest deduction is gone. Instead, you get a 20% credit. That is better than anyone else not trading. An investor in shares who borrows doesn't get a deduction for their interest. An investor in Bitcoin doesn't get a deduction for their interest, but an investor in real estate does.
Okay, I thought it was something to do with how many hours you worked in the business, and that was one of the kind of
No,
contentious points.
that's so tax has a bad habit of using similar or identical words to mean something completely different. There's a separate question for incorporation relief as to whether you're carrying on a business, but that is different from the concept of trading. So it is pretty much no landlords will be trading. To be trading in real estate, you'd be, for example, buying a house, doing it up, selling it, buying a house, doing it up, selling it. That could be a trade, although you'd have to do it really in a very quite a large scale for it to be a trade. But if you are a landlord making your money from rent, then you are not trading, but it could still be a business.
Okay, thank you for clarification there. That's very helpful. So Dan, we're coming near to the end now. Do you think the legal challenge against HMRC has any chance of success?
You mean the Property 118 challenge? The DOTAS challenge, I can't see it because, so far as I can see, the structure had the only benefit, the only effect of their structure was to get a tax advantage. So I don't really see how they have any chance there, and all the previous attempts um, to win against HMRC on DOTAS points have failed. Every single one of them, I believe. So no chance there. What about the stop notice? That is harder to say because I don't understand the facts behind the stop notice. I don't know why HMRC issued the stop notice.
So I was just going to say, isn't this dragging it out further because these tax tribunals could take years to come to
Now that's a
fruition?
great point. That's a great point. I should have mentioned it. So a lot of landlords are confused and don't understand why everything is being so slow. And the answer is it's actually being incredibly fast by the standards of normal tax disputes. So when I was in practice, I had disputes where it had been 10 years since the first HMRC letter and weren't even near a tribunal yet. Probably 118 think they'll get to a tribunal by the end of the year. Bloody hell, that's lightning fast. So yeah, tax disputes are slow. And that's a big problem if you are in one of these structures, because it means that you're going on for a long time with an unknown liability hovering over you. And unfortunately, there is no answer to that. What makes it worse is that if you're a promoter, you have every incentive to keep the ball rolling rather than reach a sort of quick, swift agreement with HMRC. The best way, likely, for landlords to reach a good settlement with HMRC will be to essentially say that they were misled, they were fooled by these promoters. They're doing something they didn't understand. The nature of it was misrepresented to them. Possibly the whole thing isn't effective. Even if it's effective, there certainly shouldn't be penalties because they were misled. The advisors are certainly not going to run arguments that say they misled people and didn't know what they were doing. They're going to keep the ball rolling because it delays the day of reckoning, because they can continue to extract fees as they do it, and because, they probably think something may turn up. Who knows? Your chance of litigation are never zero. I mean, if you have the greatest of all cases and you go to a barrister and say, so what are my chances? You'll be very disappointed because they will say, depending on the barrister, 70% or 80%. There is always an element of uncertainty. So with the worst tax avoidance case in the world, even though I can point to pretty much every single tax avoidance case having gone in HMRC's favour over the last 20, 25 years, an optimistic advisor can think, well, who knows? I'll just keep this going for a bit. The interests of the clients, on the other hand, is completely different. They will want to settle it as soon as possible.
I think there was a conflict as well with the information about the insurance held by Cotswold barristers. That's a point that's come up a lot in conversations on property forums and whatnot, because people thought that there was some line of kind of redress for them, but it's not actually for them, is it?
Both promoters were extremely, let's be kind of say, naughty in how they presented their insurance. They suggested the insurance was for the benefit of their clients, and it's not. As you say, to get that insurance, you have to sue the advisor and you have to win, and then the insurer will pay out. So the insurer is giving you some assurance that the advisor isn't just going to disappear and walk off, leaving no money there. But it's worse than that, because both advisors gave their clients the impression that their insurance amounts, which I think was something like 3 million for less tax for landlords and supposedly 10 million for Cotswold barristers, that it was per client.
Mm.
It's not the way insurance works. It's per claim. And if you have multiple claims with the same cause, the insurers will bundle them all together. It has to be like that. Less tax for landlords had over 1,000 clients. There is no way that if the same mistake is made in all of them, the insurers are going to shell out 3 billion. Come on. Yeah, it's not going to happen. They'll say that is one claim, you have to share it. So unfortunately, the insurance is much less useful than the promoter suggested, and it's also going to be worth, unfortunately, a lot less than they suggested. And the insurers may well wheedle out of it. They may well say that because of the nature of the structure, because it involved avoidance, misrepresentations, maybe even fraud, that they won't pay, because insurers are experts in not paying out under insurance.
Did you think it's possible that some clients will sue the two schemes?
I think it's pretty clear both structures were negligent, but to decide you want to sue, you need to think about what are my chances of actually getting any money from this? Am I going to win a case, spend lots of money on it, and then find there's no money left in the company and the insurers won't pay out? Can I get together with others? Can we get litigation insurance for this? Can we get a litigation funder behind us so we don't have to put money up front? Can we get enough people together that the cost for any one of us isn't too great? And these are hard questions, and there are some good people working at trying to resolve them. But I would strongly suggest to landlords they don't do anything which is going to lead them further out of pocket.
Mm.
If it's just upside, then sure, go ahead, why not? But if they're being asked to bet significant sums of money on an uncertain outcome, then that doesn't seem to me a great move.
Well, it's the old saying, throwing good money after bad, isn't it?
Correct.
Okay, so what can be done to stop a repeat of similar schemes being sold to landlords in the future?
Yeah, so there was a consultation run by the last government on regulating the tax profession. And that sadly wouldn't actually have helped in this case because Less Tax for Landlords were a regulated firm and probably 118 weren't regulated, but Cotswold's barristers, you don't get more regulated than a barrister. So there is nothing currently being done that I think would help. What I think you need, is harsh penalties for advisors who sell schemes that are doomed. And I've written about that a bit. I'm going to be writing about it more over the next few weeks. It's only if we have those incentives in place are people going to pull back from selling this kind of stuff. And also, I think insurers would be refusing to insure if the risks are so very great.
And I think education of landlords can also play a big part in stopping them falling into these traps again in the future.
That's a
Uh,
great point. Absolutely great point. Telling people to avoid the salesman and go for qualified advisors. You know what else would help? If the representative bodies for landlords could show some sign of being driven by landlords' interests and who they partner with, and not partner with dodgy firms.
so the people that are caught up in these schemes, they've got DOTAS numbers. What happens when their next return goes into HMRC?
That's a great question. Not just the next one, but should they be amending the last one? And you know, I would say clearly they should to reduce the risk to them. What are the firms advising people to do? Yeah, that's unfortunately a bit different. So possibly people who continue to be advised by these firms are just going to make their position worse year on year.
Thank you so much for your time, Dan, and your insights. And it's our hope that this interview will form part of the education of landlords around tax planning going forwards. And clearly, you did create quite a furore in the landlord tax planning landscape. But it seems from what you've said that HMRC would have come knocking eventually anyway, and you've probably done the wider community and indeed the people caught up in these schemes a favour by bringing it to the fore sooner rather than
Well, I
later.
think we call it positive disruption. I think it's probably the best way of putting it because that's what it is. And it is disruptive, but it was done in a way that needed to be done.
When we first approached Property 118 and less tax for landlords, it could have ended differently. They could have looked at what we said and said, well, these technical reasons you're giving us are actually quite compelling, and we need to go away and think about this. And if they'd done that, if they'd thought about what was in the interest of their clients, this could have been resolved in a very different way. They could have found for themselves their problems with the structure. They could have approached HMRC themselves. It would have been a much more positive outcome for their own clients. But they didn't. They reacted, both of them, with bluster. Property 118 even tried to sue me. They instructed a law firm to send me libel threats. And that has ended up with, as you put it, Vanessa, with a furore and a sort of large disruptive event in the landlord world. It didn't have to be that way.
Mm. Okay, well, thank you so much, Dan, for taking part in this call. And we do hope that this interview does form part of the learning to come out of everything that's gone on with these tax planning revelations and investigations. And, thank you so much for talking to us so openly. You didn't want to vet the questions before we started. You've answered every question we've put to you. And I'm personally very grateful to you for taking part and sharing your knowledge of tax planning in the landlord landscape. So thank you so much. And I guess we're going to stay tuned and see what happens going forwards.
Thank you for inviting me.